Welcome to Illuminati Silver. We tell you the truth about silver. Today is Tuesday the 17th of September 2019 and we're looking at the relationship between oil and gold and why potential investors could be fooled by those who either simply do not know what they're talking about or are trying to deceive you. Let's investigate. What sets this channel apart from any others, and quite frankly we're proud of it, is that we don't exist to gain clickbait revenue from Google and YouTube, or pretend that we are independent gold and silver analysts when we are secretly pumping the metal because we have commission arrangements with a bullion dealer, or that we have a burning desire to become famous because we lack status or career advancement in our private lives. We exist because we saw, as we did many years ago, when we were wealth managers and financial advisors, that the quality of advice given wasn't truly based on customer need, but more on commission earnings that the advisor would get if only he or she could persuade you to invest in product plan A as opposed to product plan B. And frankly, we were sick and tired of seeing these people get away with it. This was one of the many reasons we actually left the industry and retired early, as rather than being rewarded based on knowledge, qualifications and experience and the quality of advice given, one was rewarded based on how many of these plans or how much cash one could get out of a client. Which is why you now see so many banks and financial institutions having to pay billions in compensation for the act of mis-selling. Well, since 2011, we could see the same thing happening in the gold and silver space, where people new to this area were being suckered in by the pumpers and enticed, encouraged and motivated to spend as much of their wealth as they could, particularly on gold and silver, and yes, in the earlier days on semi-numismatic coins, which you would be lucky ever to get your investment back, even if prices doubled or trebled. Now let's be perfectly frank and open. I, the narrator of Illuminati Silver, made my first gold investment when I was 18. And over the years gradually accumulated this precious metal, slowly and methodically. And when I reached around the age of 45, began looking at silver, perhaps a little late to the game, and did the same thing, but in truth accumulated far less in monetary terms, because in the UK you pay VAT on silver, whereas gold is VAT free. That's value-added tax. Acquiring anything from 50 to 100 ounces a year, essentially in world coins, and more recently in scrap silver or items bought at or below spot price. I also, even though I wasn't remunerated, advised clients to invest anything from 5 to 10% of their investment portfolios in physical gold, essentially for hedging purposes. Controversially, Greg, one of our Inner Sanctum main commentators and contributors, used to deal in gold, silver, stamps, medals and books for over 30 years. And our other contributors are more recent purchasers, but are devout stackers of these precious metals. Now we point this out to show that we are not negative gold and silver buying, but in fact are right there with you. Even at our more advanced age in many cases, we are still accumulating slowly and methodically. So coming back to the original point, we feel and felt that innocent people have been abused by the pumpers and then re-abused by those who became disciples of the pumpers, the latter often having good intentions initially and served as mouthpieces for them simply because, to be frank, they knew no better, but believed what they were told. After all, very few people have actually been trained and time served in financial services or stock and bond trading or economics or international affairs, so why should one expect them not to believe what pumpers with expensively produced videos and often seen being interviewed on television or radio would say? So this is why our channel was set up, to attempt to set the record straight. As we put it, to tell the truth about silver and gold and precious metals, to call out the pumpers when they are pumping, and also to some degree to correct the mistakes that the disciples are also committing, often inadvertently, and finally to give good and genuine guidance to those who are interested in stacking or saving precious metals. Now, the purpose of this podcast video is to highlight a mistake that we have recently seen being spread around, which also happened a number of years ago, and recent experience has debunked the original theory, so we wish to nip it in the bud before it restarts its incorrect assessments. There is a growing build-up in the pumper and disciple community that you should pay very close attention to the price of oil because, and here's the wisdom, quote, when oil prices go up, so does the price of gold, unquote. So the pumper's contention is that the rise in oil prices is a major cause of gold and to a lesser extent silver price rises. Now, one reason, but not the only one, this has particularly come about again recently, is because for months we have been warning to watch the Iran situation very closely, as any form of potential military conflict could, and in our view most likely, lead to a flight from equities and into safe haven assets such as gold and silver. The other angle taken by these disciples is that the consequence of an Iranian conflict will also spike the price of oil, which, according to the theorists, because the oil to gold price relationship has been close over the years, will consequentially lead to gold prices rising. In other words, as the gold and oil price relationship has been so close and tended to follow one another, any spike in the price of oil leads to a spike in the price of gold. Our contention is to either completely disregard this theory or at best watch the relationship as a basket of relationships and do not, under any circumstances, regard it as the Holy Grail. Let us explain why. This is the original theory, quote, crude oil and gold prices largely move in tandem, although with occasional disconnects. High oil prices increase the costs of making and transporting goods, driving consumer prices higher. Holding gold is one way of protecting against inflation, so higher oil prices will frequently lead to a similar rise in gold, unquote. Interesting that we've got higher oil prices but lower inflation currently. And the concerns that central banks have is that we could be entering into deflation. Anyway, now the second theory we can agree with, but not the fact that it's the oil price that causes the action. Quote, higher oil prices are also often the result of geopolitical instability. A crisis in the Middle East will push oil higher, for example. When the markets are nervous, investors tend to turn to gold, which is considered one of the safest assets. A high-risk environment in the world of energy frequently translates into higher demand for gold, unquote. This begs the question, chicken or egg? Has the oil price rise actually led to an increase in the demand for gold? Or has the demand for gold indicated that there is geopolitical instability, which also therefore pushes up the price of oil? It's a moot point, but one that, again, we would rather consider that it's the geopolitical instability that causes gold and oil prices to rise, not the one leading the other. Now, therefore, it's not the higher oil price that causes gold to rise, but the political or geopolitical instability. The fact that oil prices rise at the same time is a natural consequence, as it is with other commodities that do likewise. Oil does not have to be the lead factor. Now, before we go on, let's look at what was once one of the most revered of pumpers' tools, certainly a number of years ago: the gold-to-oil ratio. Over the past 25 years, the gold-to-oil ratio has averaged 15.8, though over the last 36 years, a longer period, it's been closer to 16.7, meaning that a troy ounce of gold was worth on average the same as either 15.8 or 16.7 barrels of US crude oil. So generally, in the past, pumpers would tell you that if this ratio moves out of sync, that is, the ratio falls below this average, then you should consider buying precious metals because gold will be undervalued compared with oil. But hold on a moment. Admittedly, in 2005, that ratio was as low as 6.3, so the argument is buy gold, and it did go up at that time. But in 2016, it was as high as 36.5. Surely, the pumpers should then have been telling everyone to sell their gold as it was overpriced compared with oil. When actually, 2016 was when the gold price started to rise again. If you don't believe us, search YouTube, and you'll probably not find one pumper advocating the gold-to-oil ratio then. You see, we're old enough to remember the early 2000s, the 1990s, the 1980s, the 1970s, and incontroversially Greg's case, the Boer War, with some clarity. No, only kidding about Greg. Perplexing, isn't it? A tool that was revered suddenly disappeared. Currently, at the time of writing, WTI crude stands at $62 a barrel, and gold at this moment stands at $1,500, suggesting a gold-to-oil ratio of 24. Now, oil advocates will claim, the average relationship is 16. We're rounding the figures off between 15.8 and 16.7 to 16 to make the maths easier, which means that either gold should be worth $992 at the current oil price, or oil should be worth $93 a barrel at the current gold price. But this is where the pumper's magic comes in. Now ignoring the gold-to-oil price ratio, which suggests a fall in the price of gold or a rise in the price of oil, they now use the recent Iranian conflict, causing oil prices to rise. Now, we aren't totally convinced that oil prices will rise much further, unless, of course, the situation deteriorates further and there is a military intervention. But pumpers will advocate that in over 60% of the time, when oil prices rise, so does gold. And therefore one should consider buying gold ahead of the imminent oil price rise. Our response is the quicker we stop using these crutches to prop up our desire to see higher gold prices, the better. See, there are numerous factors affecting the price of oil. For example, and this is just a small number of many. 1. The embargo placed on Iran to export oil because of sanctions places pressure on the rest of the world to make up the deficit, and if they fail to do so, prices will of course rise. 2. Slowdown in economic growth will lead to a fall in the price of oil. 3. Geopolitical conflict tends to increase the price of oil. 4. Dollar rising will cause oil prices to fall, and the dollar falling will cause oil prices to rise as oil is denominated in dollars. 5. The expansion of US shale oil has a downward influence on global prices because of oversupply. And 6. The oil cartel OPEC dictates to a large extent the global price of oil through controlling supply, though admittedly its power and influence is weakening over time. And there are numerous other factors. Now, a number of these also affect gold, for example, the dollar value, geopolitical conflict, or an economic slowdown. But gold isn't really affected by the oil price move, with one major exception. If oil prices rise significantly, mining operations are affected as the costs of extraction become more expensive and vice versa. And this can affect gold and precious metal mining companies, and then indirectly the gold price. But other than that, one is fooling oneself if one believes that the gold to oil relationship is anything more than a minor tool in an analyst's toolbox. Useful to note and observe, but also dangerous to totally depend on. Now we hope we have brought some light and clarity on this matter. Thank you for listening, and if you haven't already done so, please subscribe to this channel. Press the bell sign so you're notified of future videos, and do sign up to our inner sanctum at illuminatisilver.com. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners. Glory, glory,